In the face of formidable challenges, the world economy has shown resilience and adaptability. This resilience is made manifest in the diverse strategies and measures nations across the globe have implemented to stimulate economic growth and foster resilience amidst an increasingly complex global landscape. Our world today stands at the intersection of numerous challenges: the lingering effects of the COVID-19 pandemic, escalating geopolitical tensions, and a host of other factors. Each of these has left an indelible mark on the global economy, prompting a reevaluation and recalibration of economic policies by governments worldwide. At the heart of these policies lie economic stimulus measures, a suite of strategies designed to mitigate financial distress and spur economic growth. These measures, as varied as the nations they originate from, range from direct cash transfer programs to infrastructure investment, tax incentives, relief measures, and interest rate adjustments. Each is a cog in the complex machinery of economic recovery, turning in tandem to navigate the path towards stability and growth. The COVID-19 pandemic in particular has necessitated an unprecedented global response. Nations have had to balance the immediate need for economic relief with the long-term goal of sustainable recovery. The measures they have implemented are a testament to this balancing act, a blend of immediate aid and strategic investment designed to ensure both survival and prosperity. Geopolitical tensions, too, have played a role in shaping these measures. As nations navigate the delicate dance of international relations, their economic policies often reflect these dynamics, balancing national interests with the need for global cooperation. Understanding this context, the challenges and the responses, is crucial. It allows us to appreciate the significance of the stimulus measures that have been implemented, to understand their impacts, and to anticipate their outcomes. It's a complex puzzle, but one that we must strive to solve. As we navigate these turbulent times, understanding the economic measures taken by nations worldwide becomes crucial. It's through this understanding that we can begin to envision the path towards a more robust and sustainable economic future, a future built on resilience, adaptability, and a shared commitment to global recovery. Let's begin with the lifeline of many during the crisis: direct cash transfer programs. In the throes of economic uncertainty, direct cash transfer programs have emerged as a beacon of hope for countless individuals and businesses. These programs, implemented by governments around the globe, aim to provide immediate relief to those most affected by the economic downturn. Across the world, the scope of these programs varies widely. In some regions, the focus has been on providing support to the most vulnerable populations, such as the unemployed, the elderly, and those living below the poverty line. In other regions, the assistance has been more universal, aiming to stimulate consumer spending and keep the wheels of the economy turning. The eligibility criteria for these programs are as diverse as their scope. Some countries have opted for a broad-based approach, providing aid to all citizens irrespective of their income level. Others have chosen a more targeted approach, ensuring that aid is directed towards those who need it most, based on factors such as income, employment status, or family size. The effectiveness of these cash transfer programs is a subject of ongoing debate. On one hand, they have undoubtedly provided a lifeline for many, enabling them to meet their basic needs and stay afloat during these challenging times. On the other hand, concerns have been raised about the sustainability of these programs and the potential for them to create dependency among recipients. Moreover, the implementation of these programs has not been without challenges. Issues such as the logistics of delivering aid, the risk of fraud, and the need for transparency and accountability have all come to the fore. Yet, despite these challenges, the benefits of direct cash transfer programs are undeniable. They have provided a crucial safety net for those hardest hit by the economic fallout, offering a glimmer of hope in a time of widespread uncertainty. In sum, these programs, while varied, have provided immediate relief to individuals and businesses alike. As we navigate through the aftermath of the global crisis, the role of direct cash transfer programs in cushioning the blow and aiding recovery cannot be overstated. Next, we turn to the concrete signs of recovery: infrastructure investment. When it comes to stimulating economies, infrastructure investment is a tried and true method. It's like a two-for-one deal. countries get the immediate benefit of the economic activity generated by the construction phase, and then the ongoing benefits that come from improved infrastructure. Let's consider a few examples. In the wake of economic downturns, several nations have initiated major infrastructure projects, ranging from transportation networks to renewable energy installations. When a government invests in a new railway line or a wind farm, it's not just laying down tracks or erecting turbines. It's injecting money into the economy, creating jobs, and stimulating a host of other industries from steel production to engineering services. But the benefits of infrastructure investment don't stop there. Once these projects are completed, they continue to contribute to the economy. Improved transportation networks can make it easier for goods to reach market, enhancing trade and boosting productivity. Renewable energy installations can reduce reliance on imported fossil fuels, improve energy security, and create a platform for new industries to flourish. Of course, infrastructure investment isn't a magic bullet for economic recovery. It requires careful planning and management to ensure that projects are delivered on time and within budget. There's also the question of how to finance these investments. Some countries have turned to public-private partnerships, while others have taken advantage of low interest rates to borrow funds. And let's not forget, these projects need to be sustainable, both economically and environmentally, to deliver long-term benefits. So while infrastructure investment can provide an immediate boost to struggling economies, it's the long-term benefits that really make it a cornerstone of economic recovery strategies. These projects not only stimulate economic activity, but also lay the groundwork for future growth. They plant the seeds for a more robust, resilient, and sustainable economy, capable of weathering future storms. And in a world where the only constant is change, that's an investment worth making. These projects not only stimulate economic activity, but also lay the groundwork for future growth. Moving on, let's delve into the world of tax incentives and relief measures. In the face of economic downturns, governments worldwide often pull levers of tax incentives and relief measures to stimulate activity. These strategies differ significantly across borders, reflecting the unique circumstances and policy goals of each nation. At their core, tax incentives are designed to encourage specific behaviors. For instance, tax credits might be offered to businesses that invest in research and development, fostering innovation and potentially leading to job creation. Meanwhile, tax deductions could be extended to companies that prioritize sustainable practices, aligning economic growth with environmental stewardship. On the other hand, tax relief measures aim to lighten the financial load on individuals and businesses. They might take the form of deferred tax payments, reduced tax rates, or even tax holidays, providing breathing room for those grappling with financial distress. The impact of these measures on businesses can be substantial. By reducing tax liabilities, they free up resources that can be invested back into the business. This can lead to expansion, job creation, and a boost in overall economic activity. However, it's important to remember that the effectiveness of these measures can vary widely, influenced by factors like the overall economic climate, the specific design of the incentives, and the financial health of the businesses involved. But what about the potential consequences for revenue collection? On one hand, tax incentives and relief measures might lead to a short-term dip in tax revenues. However, if these measures succeed in stimulating economic activity, they can actually increase tax revenues in the long run. This is because a thriving economy typically generates more taxable income and profits. There's no one-size-fits-all approach to tax incentives and relief measures. Each strategy has its own set of trade-offs and must be carefully tailored to the specific needs and circumstances of the economy in question. In conclusion, tax incentives and relief measures represent powerful tools in a government's economic toolkit. While they are complex and require careful design and implementation, they can play a crucial role in easing the burden on businesses and stimulating economic activity. These measures, though complex, play a crucial role in easing the burden on businesses and stimulating economic activity. Now let's turn our attention to the monetary levers of recovery: interest rate adjustments. Interest rate adjustments, wielded by central banks worldwide, are a powerful tool in the economic recovery toolbox. These adjustments are like the dials on a complex machine, and when turned carefully, they can stimulate economic activity in remarkable ways. So, how do these adjustments work? Well, it's all about the cost of money. When central banks lower interest rates, borrowing money becomes cheaper. For businesses, this can mean access to cheaper loans to invest in new projects or to cover operational costs during tough times. For individuals, lower interest rates can mean lower mortgage payments or more affordable car loans. By making borrowing more attractive, lower interest rates encourage spending, which in turn stimulates economic activity. On the flip side, when central banks raise interest rates, borrowing becomes more expensive. This can slow down spending and investment, which might sound like bad news. However, higher interest rates can also help control inflation and stabilize the economy, especially during periods of rapid growth. Now, the real question is, how effective are these interest rate adjustments in stimulating economic activity? The answer isn't straightforward. The effectiveness of interest rate adjustments can depend on a variety of factors, including the health of the economy, the timing of the adjustment, and the level of confidence consumers and businesses have in the economy. For instance, in a healthy economy, a cut in interest rates can encourage businesses to invest and consumers to spend, leading to increased economic activity. However, in an economy already struggling with low consumer confidence or high levels of debt, the same rate cut may not have the desired effect. In conclusion, interest rate adjustments are a primary monetary tool that can stimulate economic activity by influencing borrowing, spending, and investment. However, they are not a magic bullet. Their effectiveness depends on a multitude of factors, and they must be used judiciously in combination with other economic measures to guide a nation towards recovery. Interest rate adjustments, while a primary monetary tool, have far-reaching impacts on the economy. Let's explore the less conventional side of monetary policy, quantitative easing. At its core, quantitative easing is a strategy employed by central banks to inject money directly into the economy. This is done by purchasing large quantities of government bonds or other financial assets with the aim of encouraging lending and boosting investor confidence. Now, you might be wondering, how exactly does this work? Well, when central banks purchase these assets, they do so from commercial banks and other financial institutions. This increases the amount of cash these institutions have on hand, encouraging them to lend more. More lending translates into increased spending, which stimulates economic activity. But it isn't all sunshine and rainbows. The implementation of quantitative easing can have significant long-term effects. One of these is inflation. When more money is pumped into the economy, the value of money can decrease, leading to a rise in prices or inflation. It's a delicate balancing act for central banks to stimulate spending without causing runaway inflation. The value of a country's currency can also be affected. When a country employs quantitative easing, it typically leads to a decrease in interest rates. Lower interest rates often result in a decrease in foreign investment, which can lead to a decline in the value of the country's currency on the international market. Lastly, quantitative easing can have a profound impact on financial markets. The injection of new money can inflate asset prices, leading to increased wealth for those who own these assets. However, when quantitative easing is scaled back or stopped, these asset prices can fall, potentially causing financial instability. In a nutshell, quantitative easing is a powerful but complex tool. It has been used by central banks worldwide, from the United States to Japan, to stimulate their economies during times of financial distress. While unconventional, quantitative easing plays a significant role in stimulating economic activity and managing financial markets. Now that we've covered the various measures, let's look at some real-world examples. Let's begin with the United States, a country that implemented a massive direct cash transfer program known as the CARES Act. This stimulus package, amounting to over $2 trillion, was designed to provide immediate financial relief to individuals, small businesses, and hard-hit industries. The effectiveness of this measure is still hotly debated, but it undeniably provided a lifeline for many in the midst of uncertainty. Moving on to China, the world's second-largest economy, took a different approach. Rather than focusing on direct cash transfers, China concentrated on ramping up infrastructure investment, launching new projects worth hundreds of billions of dollars. This strategy aimed to stimulate economic activity and create jobs, and while it did boost the economy, it also raised concerns about debt sustainability. Next, let's look at the European Union. Here, the focus was on tax relief measures and liquidity support for financial institutions. By providing businesses with tax breaks and ensuring the stability of the banking sector, the EU aimed to prevent a widespread financial crisis. The effectiveness of these measures varied across member states, reflecting the diverse economic landscapes within the Union. Finally, we turn to Japan, where the central bank resorted to aggressive quantitative easing. By purchasing large quantities of government bonds and other financial assets, the Bank of Japan aimed to inject money into the economy and stimulate spending. The jury is still out on the long-term effects of this policy, but it did help to avert a deeper recession in the short term. These case studies illustrate the diverse range of economic stimulus measures adopted around the world. They show that there is no one-size-fits-all approach to economic recovery, and that the effectiveness of these measures often depends on the specific circumstances of each country. These case studies provide invaluable insights into the effectiveness of different economic stimulus measures. As we reach the end of our exploration, let's take a moment to summarize our findings. We've journeyed through the diverse economic stimulus measures deployed worldwide, from direct cash transfer programs to infrastructure investment, tax incentives, and relief measures. Each approach carries its unique potential and challenges, and their effectiveness varies across different contexts and regions. We've also explored the role of central banks in adjusting interest rates and implementing quantitative easing, and how these monetary tools impact economies. Additionally, we've delved into the measures taken to ensure the stability of financial institutions during economic downturns. Our case studies from major economies shed light on the nuances and outcomes of these stimulus measures, providing valuable lessons for future policymaking. The overall effectiveness of these strategies, their lasting implications for fiscal and monetary policy, and the role of international cooperation all contribute to our understanding of the pathways to sustained economic recovery. As we strive for a more robust and sustainable economic future, understanding these economic stimulus measures paves the way for informed policymaking.